In this video, I'm going to show you how to account for a change in accounting estimate. So estimates are a big part of accounting. Managers have to estimate how much bad debt there will be, what will be the useful life and salvage value of any property, plant, and equipment, what kind of warranty liabilities will the company have. And so they're going to make mistakes because the estimates are going to be off. And so we're going to have to make adjustments and revisions from time to time when we learn that our estimate was not right. And so what we're going to do is we're going to use something called prospective application, which is basically we just fix the mistake and we move forward. Okay, so we don't go back and restate the prior period's financial statements. If we just learn that, oh, okay, the useful life of this property, plant, and equipment is going to be 20 years instead of 16 years, we make the change, we figure out what the new depreciation is going to be, and then going forward, that's the amount of depreciation we take. We don't go back and say, well, what happened last year? What should we have done? We don't restate the financials. So we just go forward prospectively and make the accounting change. So let's do a simple example. Let's say we've got a company that bought a work truck for $60,000. And so a work truck, that's going to be property, plant, and equipment. So we're going to have to depreciate that. And so they bought it on January 1st, 2020. And let's say at that point in time, they thought the useful life would be 10 years and salvage value of 0. So then assuming that they use straight line depreciation, it would be 60,000 divided by 10. The company would take $6,000 of depreciation expense every year. Okay, that's just 60,000 divided by 10 using straight line depreciation. Now, let's assume that after 3 years, the executives at your company say, you know what? Actually, we thought the useful life would be 10 years, but actually this truck, we put a lot fewer miles on it than we thought we would, or for whatever reason, we think that now the useful life is going to be 15 years. So instead of 10, it's going to be 15. So how do we make this change? Well, again, we do not go back and restate the prior period financials. What we need to do is this. We need to say, okay, wait a minute. What's the current book value of this machine? Well, it was $60,000 when we bought it, and we took $6,000 of depreciation every year, and it's been 3 years. Okay, so $60,000 minus 3 times 6, which is 18,000. So 60,000 minus 18,000. This in the numerator here, this 42,000, that is the book value of this truck at the time that we've made this change. Okay, so it was 42,000. We'd taken 18,000 of depreciation. So there's 42,000 left remaining to be depreciated. Now, when we look at, we'll say, okay, well, it's going to be 15 years total, but 15 years, we've already had 3 years have gone by. So there's 12 years remaining. Okay, so 12 more years we're going to take it. So there's 42,000 left to be depreciated over a period of 12 more years. So if we take 42,000 and divide it by 12, we get $3,500 a year. So here's the takeaway. We used to be taking $6,000 of depreciation every year for this asset. Okay, and that's what we did for the first 3 years, and the book value is $42,000. Okay, but now going forward, we're going to take $3,500 a year of depreciation for this asset every year for the next 12 years. We don't go back and say, well, last year it should have been different, or we made a mistake. We just change the estimate. Now it's $3,500 a year depreciation. That's what we record. We just fix it and we move on.